Have you ever heard of the saying, they're asset rich, but cash poor? Well, when working in the private placement world, you quickly realize how many people fit into this category. Whether you find an investor with copper mines, diamonds, precious metals, or anything else, the fact is, hard assets have flooded the private placement business. You may say to yourself, this should be good for everyone, right? Unfortunately, it's not that simple. As you will see, going after hard asset deals can be a double-edged sword, despite what many fee-happy brokers may claim. In this video, we will cover everything you've ever wanted to know about hard asset hypothecation and how it applies to private placement programs. This will give you both direction and experience. But, most importantly, it will teach you how to ask the right questions. Before we go any further, let's define what a hard asset exactly is. By definition, in the private placement world, hard asset is any asset that is considered illiquid and is containing a value that can fluctuate based upon demand. To give you an example of what we mean, we will teach you a few of the most common hard assets qualities throughout this video. In addition, we have provided detailed summaries to help you avoid the typical hard asset learning curve. First things first, let's cover precious stones. Precious stones can be diamonds, rubies, and other precious stones owned by a collector. These stones will come with a gem certification and appraisal and should also have an SKR or safekeeping receipt as well. In most cases, precious stones are very tough to monetize unless you can sell them in the open market, or if you have a private investor to loan against them. Either way, though I have heard of gems being used for private placement trades, it should be considered rare and tough to achieve. What about valuable art? Well, this can be paintings, antiques, collectibles, and other similar items. As you would expect, this would be extremely difficult to take into trade because they are completely liquid items. The value of art is completely based upon demand, and with the unstable global markets, it has become tougher to get a loan against art than ever before. So what about precious metals? If you have an asset such as gold, silver, platinum, copper or other metals, we may have good news for you. Currently, precious metals such as gold are in high demand and can be converted into cash far easier than most assets by banks. If you have gold, you'll almost always be able to get into trade, since most banks will loan against gold bars. On the other hand, if you have lower-grade gold or other metals, you may still have a tough time finding a program to accept the asset. Let us now cover in-ground assets in the private placement world. In-ground assets are everywhere. Some examples of these are oil interests, copper mines, gold mines, and other similar assets. Even though these assets may be worth billions on their appraisals, in most cases they are pretty much worthless for private placement investments. This is due to the high excavation costs associated with removing the asset from the ground. If the bank has to spend their own money to extract value from this in-ground collateral, they will pass on it every time. So now, how does real estate incorporate itself in this vast industry? Well, if you have valuable real estate, private placement is only realistic if you get a loan against the property and then utilize the cash to invest. Despite what many private placement brokers may claim, once the real estate market crashed, it became next to impossible to use property to go into a trade. Currently, the banks are trying to retain all of the liquidity they can, and real estate is no longer a stable asset class in their eyes. Since you now understand what a hard asset is and some common examples, let's explore the burning question you all want to know. Can hard assets really be used for private placement programs? To greatly simplify the answer, yes. Hard assets can be used for private placement investments. Though this is true, you must also know that there are several obstacles associated with completing such a strenuous task. To communicate these facts to our viewers, we will give you the 5 steps to hard asset success. 1. The asset must be valuable in market and in strong demand. 2. The private placement trader must be one of the very few that are real. 3. The bank or private investor must lend against an asset and specify the LTV, also known as loan to value. 4. The trader must access a line of credit against an asset and make trades successfully. And 5. The asset must be free and clear after the private placement investment. Unfortunately, even though clients with hard assets are abundant in the private placement business, real lenders and private placement investments are not. Before the global credit crisis, it was already tough to close a hard asset deal, but in today's private placement market, it is nearly impossible. Banks across the world are holding on to as much liquid capital as possible and are extremely reluctant to loan against anything that is illiquid, such as the hard assets we discussed. In summary, if someone could successfully convert illiquid assets into a line of credit for a real bank instrument trader, they would be one of the richest people in the world. The problem is, the process of doing so relies on many moving parts which in most cases never align as planned. Though we have put effort into countless hard asset transactions which all produced nothing, we can honestly say that we have been close. If you choose to pursue these transactions like we did, remember what you have learned in this video, and you just may have a chance to beat the odds.